I'm Chris Preston.
I'm Brett Simmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network, which has been in business for more than 55 years now. Uh, Brad, speaking of being in business, it was the last day of January, 2 weeks until beginning of spring training, believe it or not. So in 2 weeks, pitchers, catchers, and Brad report to spring training. Explain.
So in fairness, it's closer to like 4 weeks to spring training. Like last year, I will be manning the hot dog slash taco stand at the Surprise Stadium, raising money for my daughter's choir group who does an annual trip to Disney. So in the back kitchen, cooking dogs, making tacos, doing dishes. Um, This year is a nice one because my daughter actually asked if I wanted to be the chaperone, so my hat is in the ring for that. So I may or may not be at Disney in May, but I'll put in I don't know, 4 to 6 weekends and we'll raise five figures for a choir group to go to Disney. It's I don't know. I guess in the like in the grand scheme of things, it's probably one of the better things that I do in the world, just as far as like improving people's lives. So uh, that's a lot of work, but I can sling dogs with the best of them.
Yeah, I would still pay to see you slinging dogs at spring training. You do apron,
Oh yeah,
yeah,
yeah. Apron. Well,
hairnet,
because
beard net.
no, I will trim the beard
Okay.
significant. Actually, yeah, maybe
Oh,
not this
that's when you
episode.
shaved it last year, right? Was it
No,
for?
that was just spur of the moment. Beard will
Okay.
be knocked down significantly in about 2 weeks,
Okay.
um, just to avoid the beard net. If
Okay.
it's less than like a half inch, I'm good.
Okay. Well,
But
we'll look forward to that. And everyone on YouTube will, I'm sure. All right. Tell people what we're going to talk about today.
big news week this week. So in lieu of a primary segment, we are just going to go through like a starting five of news items. Biggest one, obviously, DeepSeek not coming out, but catching fire over the weekend. Uh, then we'll take a look at the impact that had on the AI trade, NVIDIA in particular. We will talk about the Fed. Rates were unchanged, but there was some commentary out of that. Then we are going to look at a number of the Magnificent Seven companies that have already reported. That was another big week for that. And gold hitting fresh all-time highs. But before we get started on that, Chris, as always, it is your week to defend the hottest take you can think of. And your take this week, the DeepSeek bombshell is a good thing for the market. You have 90 seconds. You may begin.
Yeah, so obviously, these types of black swan events, market doesn't like. Market doesn't like uncertainty. It only likes what, it can predict, reasonably predict and foresee. We can go when we sat here, neither of us, maybe you did, but most people did not know, had never heard the name DeepSeek. And it was not really, people didn't really know the name until they woke up Monday morning and stocks were down 2, 3%. The S&P was down 2% that day, NASDAQ 3%. We'll get into all that. I was even thinking on Monday, I was like, I think this is a good thing because AI stocks, as we've talked about, Mag 7 in particular, have carried this bull market the last 2 years and have gotten, a bit out over their skis. If you go just by the WTAI AI ETF, it's up 70% since the start of 2023 versus 56% gain in the S&P. Um, and as the market has already breadth had already spread in January, and I think this will accelerate that spread out of tech and into other sectors. This month alone, S&P January is up 3.3%, at least coming into today. Nasdaq 2.4%. Equal weight is up more, 4.4%. Small caps 4%. Dow 5.5%. So the rest of the market is outperforming for the first time, really since this bull market began, more than two
Time.
years ago. And I think we're going to see more of that as people flee, AI, tech, and go into some of the many unloved sectors. That's why I think it's good.
Yeah. Yeah. I don't know. I like the take. I mean, we mine last week was that we'll see a 10% correction. I mean anything to get the skew out of the mega cap tech stocks is probably not a bad thing, especially if it's something that just sort of changes the narrative without entirely reversing it. Um, yeah, if DeepSeek ends up being good for smaller companies and you still get the productivity gains and all that. The gains just aren't as concentrated, but they're maybe still available. I like it.
Yeah, I mean, it's telling that while, some of the biggest names in AI, and we're gonna get to that in just a second, were, cratering, imploding on Monday, there wasn't much of a dent in the Dow, in small caps, in many sectors. Granted, a lot of those, even Nvidia and the likes of, some the big AI names have bounced back since Monday, but they're still underwater for the week, given how much they fell. Everything else is basically flat to up for the week. So hopefully that's a sign of things to come. But let's get to our starting five this week. Let's talk a little bit more about DeepSeek, what it means, what it is. You've done a deep dive on DeepSeek, Brad, and I've just been talking for a while, so I'll let you go here.
Okay, so, All right. So this is, I think, probably where I am capping out on technical knowledge. I will do my absolute best to convey this as accurately as possible as I understand it. If you are in comp sci or machine learning or anything like that, and I am dead wrong, my apologies. But um,
We're an investing podcast. People don't come here for tech knowledge. Do your best, and that's all you
so
can.
So DeepSeek is a reinforcement learning, it's a distilled reinforcement learning model. And there are, for the purposes of like the financial media, there are essentially two different DeepSeeks. One is the App Store version and the version that's available to individuals to access via the internet that uses the DeepSeek model and it uses the AI, but you're going through sort of the Chinese tech framework. What is being, I think, discussed more as far as how it would impact NVIDIA, as far as it would impact other companies, is the model itself and the training process. The model itself is an open model, which means they make freely available to anybody that wants to use it, that has the ability to download it and run it locally. They make their model weightings available. So you can take advantage of sort of the training that they've done if you are a hobbyist or if you're a smaller company or if you're, I think, small to mid-sized businesses that are in the AI space will be the biggest beneficiaries of this. They can use the outcome of the training and the process, and they can run their own versions locally where it obviates some of the concerns about the tech. So on that front, the the consumer facing version of DeepSeek has a lot of like privacy concerns. They actually had a data breach 2 days ago where, the Chinese party is able to access user logs and queries and all that stuff. So that's a little bit problematic. That is not really what moved the market. DeepSeek itself has been around since last year. It started gaining traction online in December. The key difference, I think the best way to put it is it's kind of a PC moment for AIs. So if you think back to 30, 40 years ago, say pre the proliferation of the personal computer, if you wanted to use a computer, you would essentially have to you would have to go to somebody that had, a supercomputer or a server or something along those lines. And then the PC really democratized that. And that, I think, is what we're seeing with DeepSeek, where the narrative for the bull market was mega cap tech companies. They are the only ones with the infrastructure to support large language models. They're the only ones with access to power, access to bandwidth, access to the chips. So they were essentially centralized hubs where if you wanted to access whatever the cutting edge AI was, you had to go through them. What DeepSeek did is they used these foundational models like Llama, like OpenAI, and they used those models to then train what are called distilled models like DeepSeek, which instead of relying on access to these huge data sets, these models are essentially piggybacking on the existing large language models to learn, for lack of a better word, what their thought process is. Uh, you'll see it written up as a sort of teacher-student relationship, or alternatively, they use the word mixture of experts. So what that ends up meaning is instead of a multi-purpose sort of universal knowledge or universal AI that has access to the huge database, you have something that's more focused and more specialized. And that narrow focus means that instead of having to know everything, it just has to know one area really well, and it has to be able to reason how to get to certain solutions. To do that, what they are doing is they're using a process called reinforcement learning. In the case of DeepSeek, what they did is they took inputs where the outputs are known, so math equations, programming, and using the transformer architecture of these machine learning platform or this machine learning architecture, they are able to then sort of guide or allow DeepSeek to guide itself to understand how to reach these known solutions. What that ends up doing is it allows for faster processing, lower cost, lower energy consumption, better accuracy on benchmark tests, but it's less universal. So, one of the early sort of criticisms of DeepSeek, which they've since refined out, is that it was inconsistent with language use. So it knew how to reason and achieve its objectives better, but it wasn't as customer facing, I guess you would call it. Where it is beneficial, I think, for in the investing landscape, like I said before, is small to mid-sized businesses, especially software as a service. If you are, say, a medical imaging company, you don't need any AI tool that you're using to be able to write Shakespeare. You just need it to be really exceptional with medical imaging, with diagnosing, with reading results. And it's also something where you have a lot of input with known outcomes. So cancer screening, right? If you are medical imaging and you're focused on cancer screening, you could look at a ton of MRIs, a ton of X-rays, and then you have a known outcome, and you can point this distilled model towards the specific outcome. Uh, China actually had a fusion power generating breakthrough where they went, I think, over 1,000 milliseconds of stability, which seems to be piggybacking on some research that was done in the University of South Korea, where they used machine learning to essentially predict a breakdown in plasma flows. And it very much seems like the cutting edge AI refining technology is coming out of China. It seems like they have leveraged some of this technology to already generate results in the science fields. I think that is really where the focus is going to be for now, until we start seeing more distilled model distribution in the US. And then you're going to find more and more niche applications. So in the short term, it's bad for big tech because access to data centers is no longer explicitly a gatekeeping mechanism. They will be gatekeepers insofar as using their foundational models is a prerequisite to building these distilled models. But once these distilled models have extrapolated out, you're going to see a lot more competition in the AI space, especially when it comes to AI product offerings. I don't know that you're going to see a lot of proliferation in consumer tech right away. I think it'll be research focused and industry specific, and it's going to be highly specialized. But Mark Andreessen of what Andreessen Horowitz called it the Sputnik moment, um, where obviously it demonstrated we had this preconception that the U.S. was the only country that was going to be able to generate this technology, and here comes a Chinese tech firm that allegedly spent $6 million to develop a model that is better than some of our best models. So I think it's going to have limited impact on a limited, let's say, limited profit opportunity. It's going to take a little while to find the companies that will really be able to leverage this to turn a profit. And I think it's going to be kind of niche to begin with, but it does shake up that narrative of these huge data centers that are mega power draws, that are relying on tons and tons of chips. That narrative becomes secondary. It's less important. It's going to be less of a profit driver. Mike has said these companies are going to be in the penalty box for a while. I think that's probably accurate. Obviously, they've bounced back, not entirely, but pretty nicely since that sell-off on Monday. But it is very, very disruptive to the existing AI narrative without necessarily being disruptive to the AI technology itself.
Yeah, and one sort of byproduct of that, or one other sector that's sort of taking shrapnel from it is utilities, namely nuclear energy providers, many of whom have signed big contracts with some of the biggest tech. Constellation Energy comes to mind, CEG. They are reopening 3 Mile Island, which is not something I ever thought you'd say, to help provide energy to AI data centers for Microsoft. Um, Signed a record deal with them. Um, Amazon, who was it that signed with Amazon? Uh, Gosh, I can't remember. Maybe it wasn't Amazon. Anyway, their Centrus Energy is another one that was down. That's one of the biggest nuclear energy providers. Those CEG, which is Constellation Energy, was down 21% on Monday. Centrus Energy was down um, about, let's see, it fell from 92 to 78
Yeah.
just on Monday. So those are sort of getting dragged down along with, some of the biggest names in AI. NVIDIA down 17% Monday, Broadcom down 20%, Supermicro Computer down 15%, Oracle 13%, and so on. Um, yeah, I think it seems like you explained that beautifully. Not that I would know, but
So
uh,
I want to throw a couple of items out. One, Microsoft added the DeepSeek model to their Azure cloud computing platform. Um, that I don't think is a big needle mover. If one of the mega cap tech companies is actually going to benefit from it, it's Meta. Meta's Llama platform is their open source foundational AI model. So they were used by DeepSeek in development. I mean, DeepSeek said they used multiple foundational models, but if you're looking at people that are maybe putting together their own platform or their own services, it's more likely that they are going to use something like an open source model like Llama, coupled with open model weightings from DeepSeek. Um, I think one way to think of it that is maybe useful, if a little bit of a rough analogy would be, imagine if every time you wanted to Google something or look up something online, you had to go to like IBM's Big Blue supercomputer. Like that's not really tenable, and then IBM can set like if it's like, okay, well, it's $10,000 an hour if you want to use a computer. That was the model that we had before. Now the model that we have is you can just access it. You can just download this and run it locally. Yeah, you still have to have the computer, but it is very good for democratizing these models in a way that frankly we have not seen yet in the last we have not seen in the last 2 years.
yeah, and just to clean up what I said before, it was not Amazon that signed a deal. It was Google signed a Google Energy deal with Kairos Power, Kairos. But it's this funny. I found an article from Goldman Sachs literally a week ago, or a little over a week ago, January 23rd. Is nuclear energy the answer to AI data centers power? Seems like that they might, you know, this might at least throw the brakes on that for a little bit. Um, or at the very least, the narrative will be working against some of these, big nuclear energy companies. Um,
Yeah,
and
they'll still have to grow to provide power to the data centers, but if the distilled model is the way that AI goes for the foreseeable future, you just need less of it. So you
yeah,
probably have, I know we'll talk about Microsoft's earnings. They they think their capex or their capex growth is not accelerating as quickly. Um, so I think probably see a pullback in spending because it's not like it's not like you need to use these huge data centers for every AI interaction now. It's like, well, you need it to build better, faster models.
Yeah.
So some of the obvious growth I think has been pulled back, been pulled out of the Nvidias. Corning is one that they do optics. The server makers, power companies, as you're saying, that obvious growth I think is gone
Yeah.
for now, at least in the long run. Yeah, they'll probably do fine, but in the short run, that catalyst has really changed.
Yeah, penalty box, as Mike said. It's a good way of framing it. All right, let's move on from DeepSeek and AI. The Fed spoke this week, very busy week. It was already supposed to be a busy week, and DeepSeek really kicked things into overdrive right away. Fed stayed the course, no rate cuts. Powell didn't say too much that was of interest, other than they're not dead set on, you know, inflation getting all the way down to their 2% target. You and I have speculated that, maybe in the ballpark might do it. Um,
Yeah, yeah, that was always your baby, so I will give you full credit for that one. That's
yeah, I mean,
something that you've been saying for over a year now is, hey, the Fed is not going to be held to that 2% exactly before they make moves. They're going to be looking at stuff that's in the ballpark, in the neighborhood. So kudos to you. That was the right move, the right call.
thank you. Well, yeah, as soon as they got under 3% is when, right around the time they started cutting. Um, and now there were fears that people had feared that, things had completely flipped with inflation being as stubborn as it's been. It's not going up, but it's having a hard time getting through sort of the high twos, mid twos area. And I think were some fears that they would possibly hold rates steady all year, if not raise them. I Nothing he said made me think that. He's saying basically the same lines that he's had. We have a dual responsibility, on both sides. We don't want to cut too quickly, but we don't want to hold rates high for too long. My guess is, have been great. You and I have been mostly good at guessing these things, although we underestimated what they were going to do at the end of last year. Second half of the year, I would bet they'd cut twice. I think like their own dot plot had them cutting twice this year, I believe.
Yeah.
Um, I would bet that they, would still cut 25 basis points twice this year, probably in the second half of the year. But things can change. It all depends on what the inflation data is that comes in. He didn't say anything to me that changed the narrative much, and the market sort of reacted accordingly. Market did implode, the way it did, I think, after their last report. Not implode, but pull back. Um, but it also didn't get up, it wasn't a big sigh of relief the way the improved inflation data, or slightly cooler than expected inflation data that came in earlier in the month, was to sort of turn around the market after a rough 6 weeks.
Yeah. Yeah. And, in regards to the market sort of responding in a muted fashion, uh, before the meeting, so a week ago, there was the CME Fed Watch had a 45% chance that there would be a single rate cut by June with a 21% chance that there'd be two rate cuts by then. The odds now 47% of a single rate cut by June, 20% of two rate cuts. But the percentage, about a third of people are expecting that rates are going to be the same, and about two-thirds are expecting that rates are going to be lower. It does very much seem like a bet on the headlines, right?
Hmm.
Like look, if we get hammered by tariffs this weekend, which is a possibility,
Yeah, we'll
that
get that.
probably changes the Fed's calculus a little bit. But this was very much as expected. The only thing that I caught that was a little bit different, or that signaled that the Fed's minds might be changing a little bit, is some language from their statement, which in the December statement they said inflation has made progress towards the committee's 2% objective, but remains somewhat elevated. They removed the progress part of that. They now are just saying inflation remains somewhat elevated. So
Hmm.
they're fully acknowledging that inflation isn't going to drop exactly down to 2%, and it's not going to do it in a month or 2 months or 6 months. It's going to be longer. It's going to be higher for, I mean, we've been saying higher for longer for so long, but yeah, it's going to hold up. We'll see what happens with tariffs. I mean,
Yeah. Yeah. I mean, the good
and
news is that and I think a big reason why the market didn't react one way or the other. The bond yields, 10-year bond, held firm just above 4.5% ish range, which is, I've written about and talked about on here. That is sort of the magic number. Anything below that, the market tends to like. But really, just the fall from 4.8% after the inflation numbers earlier this month, when it seemed like, they're ticketed for 5% or higher, really turned things around in the market. So I think, holding steady there is a good thing, at least for now. Um, we're not where we were in December and January, where, bond yields and sort of interest rate pessimism were on the rise. So, no harm done, it seems,
yeah,
at least, which is,
abs
there's not another one of these until March, Fed meetings, that is. So that's a good thing. Getting by unscathed, where, the Fed briefly turned from friend to or foe to friend. It's now a little bit more in the foe area, unfortunately, until, inflation clears up and they start cutting again.
yeah, absolutely. I think watching that 10-year yield is a good like single number to watch.
Yeah.
We talked a couple of weeks ago, or I mentioned a couple of weeks ago that there's like a 120 basis point spread typically between like the Fed funds rate and the 10-year. The 10-year moves slower and it tends to look ahead further because ostensibly it's smart money. So if we're seeing the 10-year hanging around 4.5%, but with short-term rates at 4.25, that seems to be indicating that the bond market is expecting that rate cuts are going to line up with the dot plot and that
Yeah.
we'll probably get two cuts this year.
Right.
If we see tariffs, if we see strong inflation and that 10-year starts pushing up towards 5% or 5.5%, that is the bond market pricing out expectations of cuts. So if you want to check one thing, I think that the 10-year treasury yield is probably a smart way to do that.
It's funny when we sat here a year ago, and well, that's probably the beginning of last January, when I think optimism over the pace of rate cuts was too high. I think people were calling for six rate cuts. Ended up being four. I mean, a full percentage point, full 100 basis points. So it wasn't that far off. But you and I were more in the, I think we had said, we thought there'd be three. I think things seemed a little too overly optimistic about the pace last year. I'd say they're overly pessimistic now. I could see, two as their dot plot, but I wouldn't be surprised if they go three cuts this year, 75 basis points. But again, it'll depend on the data, of course.
Yeah, I guess if we're placing bets right now, I'll say, man, I don't want to say two because that's what the Fed is just saying they're going to do two. So me saying
I'll say three.
I'll take one or less. I'll
Wait,
go just to make it
so you're
interesting.
overly pessimistic. What a shocker.
I don't the problem is tariffs.
I know.
Right? Like it's headline driven. It's not like fundamentals driven right now.
Yeah.
The Fed did say that we're in a low hire environment. So the labor market has cooled to the extent that they want it to. So they're not really incentivized to cool that anymore. They're going to be entirely inflation dependent, and unfortunately, well, all right. So I was going to say, unfortunately, inflation is going to be really entirely dependent upon tariffs and like fiscal policy. But I guess if the economy is in super strong shape and starts heating up a bunch, then they're also disincentivized from cutting. So uh,
Right.
just pretend I'm being super bullish on the strength of the economy and I'm not being my normal bear self.
Okay. Well, why don't we just switch up the order briefly since we're already on the subject of tariffs. Gold has hit new all-time highs. Silver outpacing even gold. Both are up big in the last week, and that's um, uh, they're acting as a safe haven as the tariff deadline. I think is tomorrow, right? Um, and people don't know really what tariffs will be, who, how much they'll be, China, Mexico, Canada, all on the table. I guess Colombia.
Taiwan.
What's yeah,
There's talk about tariffs on Taiwanese chips,
yeah,
which I don't know exactly how that'll work because Taiwan Semi has a facility like 20 minutes from my house where
yeah,
they are producing domestically the chips. So I don't know if they're going to exempt some chips from tariffs because they're made in the US or if it's going to be a blanket application of any chips made by Taiwan Semi.
yeah.
Um,
Um, so gold at all-time highs, 28.56 an ounce. It's already up 9% year to date, more than 9% year to date, and it's up uh, more than $100 just this week alone. And then silver up more than 12% this month. It's at $32. Let's see how that compares to, yeah, up 11.5% this month. And that's not quite all-time highs for silver. It's up $33 in October, just ahead of the election. But I guess really just wanted to point this out. I don't know. We keep saying that, feels like gold, might have peaked for a while. Gold and silver may have peaked for a while, and then it keeps rising higher. Credit to Cliff Droke, who's a golden metals expert who we've had on, who runs our Cabot turnaround letter, who we've had on here multiple times. And every time he's been high on, he said, no, I'm still high on gold. I'm high on silver, even though they're at all-time highs or close to it. He's been right. So, I keep wanting to say, fade gold, but uh, it's hard to bet against it at this point, especially, with the maybe that'll change tomorrow if the tariffs come in, lighter than expected. But
yeah, I think that's probably your risk. I've seen reports online that there's metal shortages in like London and in some metals dealers in like New York. So people taking more physical delivery of it. It's I don't know. I was not a cap in the first Trump term. I started on what election day, right when so election day of
is it
like
election day?
2020. Yeah. Um, I started in November of 2020. I don't remember specifically how the day-to-day market moves were under the first administration. Obviously, we had COVID taking up like half of his first administration, or not half, but taking up the last quarter of his administration. But the headline risk of all of this is really tough to navigate.
Yeah.
Um, it, because
Yeah, sorry, since that Trump has set a Saturday deadline to slap a 25% tariff on imports from Canada and Mexico, and said he was still considering new tariffs on Chinese goods. So it's just specifically Canada and Mexico tomorrow.
yeah, if he comes out and says 25%, all right, well, the market's probably pricing that in. It's probably still good for gold and silver. If he says, well, now, you know what, we're going to do 50% because he feels like it, then you see continued buying pressure in the metals, I think, and probably a lot more uncertainty in the market. It's tough to try and game out what the future might look like when there's a lot of volatility beyond just normal headline risk. It, the headline risk is itself very volatile. Um, I mean, if he comes out and says no tariffs whatsoever, I think you're at risk that maybe gold retraces some of these gains, certainly.
Yeah. So I, all you have to do is wait a day to find to find out, at least with
Yeah.
25% tariffs on Mexico and Canada. So we'll see. Okay, and finally, there's a big one. It was a big week for Mag 7, some of the Mag 7 companies in earnings. Tesla, Meta, Apple, Microsoft all reported in the last week. Mixed results, I'd say. Teslas are were probably the most underwhelming because they showed negative growth again after a promising third quarter. They're sort of right back to the previous three quarters were negative to flat growth, and that's what this was. Let's see, I have the numbers right here. Um, so yeah, hold on. You go on with the market reaction. Let me pull these up. I thought I had them right at my fingertips, but I don't. Um, yeah, some go. I'd say Microsoft and Tesla were on sort of the not so great end of the ledger, whereas Apple and Meta's were a little bit better.
Yeah, Tesla is up 2.9% in the last week. Most of that came on the earnings announcement. They reported 73 cents a share in earnings on 25.7 billion in revenue. The
Hmm.
expectations were 78 cents in earnings on 27.3 billion in revenue.
Right.
Meta was up 1.5% on the heels of their earnings, 802 a share on 48.4 billion in revenue, which was up 50% and 21% respectively from a year ago. They also announced that they were going to hike their capital expenditures to a range of 60 to 65 billion, and they have, at least per their reporting, 700 million monthly active users of the Meta AI tool. So that's the Llama open source platform. That's their growth opportunity. I mean, most of their money is coming from advertising, but I think that makes them the biggest potential winner if we see a changing of the guard for how the AI thing is going to play out. Microsoft fell 6%, at 3.23 of earnings on 69.6 billion in revenue. It was up 10 and 12% respectively. That was a little bit ahead of expectations. 312 on 68.8 billion revenue were expected. Their Azure cloud growth, so their AI platform, their growth rate came down from 33 to 31%. So still growing really rapidly, just not as quickly as last quarter. And then Apple, they're up about 1.9% today after reporting. They had $2.40 in earnings against 235 expected, 124 billion in revenue, 124.3 versus 124.1 billion expected. So they came in sort of where they should have.
Yeah.
Um, iPhones missed on revenues for them, 69 and change against 71 expected. And then their China, they're slowing down a lot, 18.5 billion against 21.5 billion. The one thing I want to call out with Apple, um, they were not the only one, but they they were really, really resilient when the AI narrative sort of imploded on Monday. Um, they didn't take a hit at all. They're
Yeah.
holding up remarkably well. That's,
They're not
I
nearly as
have
leveraged to AI.
yeah, exactly. I have been on record saying that I think that they're probably the safest bet in the Mag 7 simply because they are not leveraged to AI. And I didn't anticipate that the AI narrative was going to get dented by a distilled model coming out of China that has been out for a month, but people just sort of caught wind of. But that's it. That's exactly why I was saying and have been saying I like Apple of the Mag 7. Although given that limitation to their upside growth and some of the slowdowns in China, I think Meta now probably becomes an outperformer. But if you're
Yeah.
looking for a safe way to play it, I think Apple is still the safest bet.
Right. Um, yeah, it's what's interesting is, going back to Tesla, because they before report their deliveries before they report full earnings, the deliveries had already underwhelmed. So the stock price had fallen from 426 mid-January down to 389 the day they reported earnings and are up since then. So I think the underwhelming quarter was already baked in, but it does seem like Tesla is um, still in sort of the honeymoon phase from the Trump election and Elon Musk becoming part of Trump's cabinet and all of that sort of being sort of um, theoretically bullish for Tesla. It seems like that's already that wave, that honeymoon phase has passed a bit, and we're, back in sort of reality phase. Topped out around 480, all-time high, 480 in mid-December. It's now just under 420, 418. But it seems like, the sort of the sell-off, the selling in Tesla has passed a bit, but it might be a little bit capped and sort of in this same, low 400s range for a while, given the sort of underwhelming quarter that it just reported.
It's also worth noting that their quarter was partially buoyed by change in accounting rules for Bitcoin, which is something they have on their balance sheet. So the new accounting rules require that you recognize gains as well as losses. So in the past, you only had to you could mark to market losses on Bitcoin. So if you had $100 million of it and it fell in value to 50 million, you could take the loss. But if it doubled in value to 200 million, you didn't have to report the gain. That has changed. So 600 million of their profit last year was due to Bitcoin appreciation. That's 10% of their full year profits. So the the quarterly figures are being pulled up a little bit even beyond what was probably a little bit disappointing.
Yeah.
Um, I mean, the thing with Tesla though, Austin is supposedly going to have unsupervised full self-drive. There's just Tesla is the perpetual moonshot. Everything they do is a moonshot. And the good thing about moonshots, I guess, if you're an investor, is if they fail, everybody expected them to fail. They were moonshots. And if they succeed, oh my God, they succeeded. That's a home run. It's coming up to the plate and swing for a home run every single time. It's like, yeah, you strike out a bunch, but everybody expects you to. Like boring tunnel, right? That absolute failure, but everybody expected it to be a failure. But then something like SpaceX takes off, is huge, is the biggest payload mover on the planet, government contractor, Starlink, right? Like all these other moonshots that are paying off. You you just don't you can't just look at it as a car company for good and for bad.
Yeah. Well, it's a moonshot that's gone to the moon. I mean, if you
Yeah,
invested years ago, and every time people sort of give up on it, it was pretty sluggish for a year, a couple of years, really, up until just prior to the election, and it's taken off since then. Um,
they talked about the Optimus robot line being maybe like $1 trillion market. I don't have the exact context for that figure, but that was something that I had seen. Um, I don't know. I don't expect Optimus to be like the universal robot that becomes ubiquitous that everybody's got and it's suddenly $1 trillion market. But if it's not, you just write it off as Musk bluster. But if it hits big. So
yeah,
uh, I
like
think
it might fall in the Cybertruck category. I have one
probably,
in my neighborhood.
but
It is ugly
Cybertruck,
as sin. I'm sorry. They look
yeah.
terrible. I don't know if you have any near you.
We've got one in the area that drives around. I don't like it. Not It's not bulletproof or armored, despite what people seem to think. Doesn't
Oh,
hold up in cold weather. The stainless steel isn't super high quality and tends to get discolored really easily, I understand.
yeah,
Um,
it's a good the guy in my neighborhood has a gray one. It's looking pretty rough. Even though I know he hasn't had it for that long.
Taking it
Um,
off road voids your warranty for
really?
this.
Yeah.
Yeah, it's in their what warranty terms of and conditions is if you drive off road, your warranty is voided.
Yeah.
Um,
That
but
hasn't been the revolutionary product that Elon had forecast. So yeah, you got to take some of what Elon says, $1 trillion market for robots.
it,
I don't
it's
think we're
just the tough thing with Tesla, I think, as an investor and as somebody who thinks it's over a little bit overvalued from I can't bet you can't bet on the fundamentals of it. People aren't People are trading it based on what they think can happen and what they think can happen could be a total success like a lot of things they've done or it could be an abject failure. So it's really just a consideration of investor psychology more than anything else. It makes it a real tough company to try and use any kind of fundamental metrics on at
Yeah.
all. And I think that's probably why people are very divided on it. The ones that love it, absolutely, especially if you own it. If you own it, you love it because it's made you a fortune.
Yeah.
If you missed it because you were a skeptic the whole time, you hate it because it's irrational. It's sort of the Breaking Bad. He can't keep getting away with this thing.
Right.
Um,
Uh, yeah, I've had friends, railing against the stock, for going back 5, 6, 7, 8 years. Like, meanwhile, everyone who has it is just, raking in profits every single year. So, yeah, if you have it, definitely don't get rid of it anytime soon. Um, okay, one last thing before we go. We're offering everyone who's listening today special access, discounted access to Mike Centilla. We mentioned Mike a couple of times, who's been on here a bunch. His Cabot Growth Investor service, which is our signature flagship investment advisory. It's been around since Cabot's inception in 1970, formerly Cabot Market Letter. Cabot Growth Investor, we're offering for 60% off the normal price today, just $197 for the year, which is quite a deal for someone who's, Mike has beaten the market for he's been in charge of that newsletter for about 20 years now and beats the market almost every year. 60% off the normal price, $197 for the year, and a 30-day 100% money back guarantee if for some reason you don't like it. All you have to do is go to cabotwealth.com/street. Cabotwealth.com/street. We'll have that in the summary on YouTube. But again, 60% off the normal price for Cabot Growth Investor, which is under the guiding hand of Mike Santola, which is a good person to have guide your portfolio decisions.
yeah,
Any last words before we sign off? Sorry, what do you got?
I wanted to piggyback on that a little bit. Mike had it last year. Mike's subscribers ended up having been in the best performing stock in the S&P 500, and he had them watching it very, very early.
Mhm.
So, as much as as much as maybe you and I are fast and loose, Mike is a excellent, excellent analyst,
Mhm.
and a lot of the things that we'll talk about on this podcast, he'll be covering in advance. He tends to be really good at identifying trends early. So if you are considering something, CGI is a good place to start.
Yeah, there you go. Okay, I think that's a podcast. We'll be back next week to talk about stocks and hot dogs and all kinds of other things. Any closing words before we sign off?
No,
Okay. No more on DeepSeek, you sure?
I'm
You got-
I'm sure.
Yeah, okay. All right. Thanks for joining us, and we'll see you in next week's Cabot Street Check. Thanks.